Hi everyone, welcome back to our podcast, the Accounting and Tax Helpdesk. We are here to discuss about different topics in tax world and the common questions that a lot of people have. All right, today we're going to talk more about the write-offs, the things that everybody talks about in the parties, everybody, and you always maybe remember the famous quotes from Kramer in Seinfeld about the write-offs. There are some people that knows about write-offs and they do the write-offs. So we're going to dig into what the write-off is. So let's dive into the wonderful life of the write-offs and see how it helps people to decrease their taxable income. So basically, write-off is the business expenses that help you to decrease your taxable income. And when you calculate your tax, it's going to decrease the amount of taxable income that the tax is going to be calculated on. The write-offs, let's just say it in the beginning, is not for W-2 employees. So if you're employees and you want to have a write-off and say, oh, my neighbor writing off her expenses or his expenses, is not the case. If you're W-2 employees, you're not in good luck. But if you're a self-employed or you have a business, write-off is your friend. So let's see, like IRS have a light side too. So sometimes say, okay, you work hard, okay, I'll let you to deduct some of your taxable income. So some people say, okay, I'm a W-2 employee. Should I create another entities and then write off stuff? The answer is, if you have a business, if you have an operation, then you create a business. You don't create a business to just write things off. Because, for example, you need to earn money and then you write off those expenses against your income.
Great answer. Okay. Now, can personal expenses ever be written off? If so, under what circumstances?
Personal expenses can be written off, but to the portion that is business related. So the magic word is proportion. What proportion of your work, those personal expenses are business related? Let's say your car expenses. You get into your car, go to the grocery shopping, and then go meet your clients. That portion that you drive to your clients for a meeting or anything business related is, you can write it off as an expense. That portion of your expenses is business expense. So it could be a mileage, it could be a gas, it could be repairs or anything. If you have a home office, you need to have a workspace. You need to have calculate how much of the home is occupied, how much of your office occupied the home. So it's about size. So in this case, in anything like anything else, size matters. But then it's a good thing is in proportion. So your home office compared to the whole home is gonna be determine that how much of expense you can write off. So you need to identify. So how to calculate your home office expenses? The first step is to determine the workspace. Okay, this is my workspace, and then you just measure it, and then but by the measurement, and then you keep track of your records of utilities and rents, and then any overhead expenses, and based on the measurements and the records, you calculate your home office expenses, and you can call your CPA or accountant and consult with your CPAs. All right, so let's talk about how to keep track of your expenses. So the first thing, keep track of your expenses like a pro. Like if you spend something, you get a receipt, take a digital copy. And then with all of these apps these days, it's easy just to record all of those, have all of those records in your computer or anywhere, and you don't have the physical copy, but you need to keep all the receipts. For IRS, you need to keep them for about 3 years. If then the other thing, if you have a business, you need to have a proper bookkeeping to keep track of all of the records during the year. That's another thing that I can talk about it more in details, but with proper bookkeeping and then keep all of your receipts, you would have a proper bookkeeping, and then use all different softwares and apps, and then all in your site, so you can keep track of all of your expenses. Okay, so when you're a W-2 employee and then you become a self-employed, so that's the challenging part that always you have. Like, okay, now nobody withhold taxes for me, and then I need to pay taxes. How much I need to pay taxes? So that's why the proper bookkeeping and keep track of all of your records is play an important role. So you need to have proper bookkeeping to see what's your net income is, and then based on that, and based with the consulting with your CPA or your accountant, you can calculate your estimated tax during the year. So let's say your tax bracket is 20 to 30%. So based on your net income, you need to put aside 20 or 30% for taxes. So don't spend all of your money that you receive when you're self-employed, because you need to pay later. So some people ask me, so is there any limits? What's the line? And I'll say, okay, don't get wild. Don't get wild when it comes to the deduction. For the couple of things, it's too good to be true. You make $100,000 and you see write-offs of 95,000. It doesn't make sense. First, for a business side, if on 100,000 you have expense of 95,000, just stop that business. I know the first year you may have like some expenses that you have to incur, but if in several years you see businesses that they just have a write-offs, not income, so it's not it's a red flag. And then IRS would do a favor, just don't do that business because you're just losing money. For example, like a person is just teaching, tutoring, and then have like 5,000 income and then have 10,000 expenses. So it's good to be true. And then first, why do that business that you're losing 5,000 a year? So just don't do that business. Do yourself a favor. But at the same time, if you just keep doing that expenses, then it's kind of like waving a red flag in front of the IRS. So the first thing, so good to be true. The second thing is the wrong categories. Like, for example, you're a rider and you have huge expenses for heavy equipment, like a copy machine, yes. Something like a huge expenses that is not related to your nature of your business. So these things that there is, and then the other thing is a round number. For example, you see a lot of round number in your expenses. Office supplies, 5,000. Office expenses, $1,000. Round numbers, not good categories of expenses, and then so good to be true. These three things that could be it's not your limit, is the red flags that waving in front of IRS. So anything business related, you can write it off. Anything is truly business related and help you to run your business, it's a business expense and you can write it off. But if you want to go between, and the other red flag is between your personal expense and your business expense. I know we talk about it, that some personal expenses you can write it off, but that's the time that you need to be careful. If you go traveling with your family, going to Cayman Islands, for example, and it's not business related, you can just write it off as a business expense because you're paying from your business and it's a travel. So it's a line between your personal, the IRS is very careful, is like paying attention to those areas that could be mixed up in a personal and business expense. So like travel expense is one area that IRS will look into the details. Meals and entertainment is the one category that IRS will look into the details, because that's a line that people mix up the business and entertainment. So some very common write-offs for businesses. Let's start with the home office expenses, because a lot of people use your part of their home as an office and they work. So the one part is home office expenses that some people just don't deduct it. The other thing is when they started a business, there are a lot of expenses that they paying and then they don't keep track of it because it's in their beginning of their business. Like they go for advertising, research, they pay some legal fees. These are expenses of the startup costs that those are deductible, and sometimes the clients forget to claim those. Anything related to your supplies that you sometimes you pay with your personal account, but it's work related. These are all expenses that overlooked for deduction. Claiming your car expenses and mileage, and any expenses that overhead expenses that is a line between your business and personal expenses, or those expenses that kind of being overlooked. Let's say you drive to you're a rider and let's say you're a rider and then you want to talk about the opportunity with the editors, and then to see if there is a chance you could go get into your car. First, we need, maybe I need to get something for home for grocery shopping. So you stop at grocery shopping and you buy some stuff, and then from there you go to your meeting to meet the editors, and they might not have nothing happen. Maybe editors reject you, or it's not going to work out. But that portion still is a business related. So that portion of your expenses is related to your car. So and these days there are a lot of apps that help you keep track of those mileage. But it's very easy. There are a lot of apps that can help you to keep track of all of records. But still, it's very important to have a CPA, an accountant, a professional that help you. A professional in Calabasas is much better. Like Alamir CPA in Calabasas, we're here to help you. If you have any questions about those expenses, claim expenses, just give us a call or email us. A lot of times, people get confused between the tax deduction and tax credits. So look at the tax deduction as a coupon. You go on the sales, you buy clothes, it says 20% off. So it means, okay, the clothes is $100. Instead of paying $100, you pay that for that merchandise $80 because it's 20% off. So it's not, you get the deduction on the based on the percentage, and then basically deduction bring down your taxable income. The tax is going to be calculated on. Let's say a lot of people when donate, or they hear somebody donate, they say, oh, they write it off. So it's not, they don't do anything very special because they just write it up. But it's not the case. Let's say somebody donated $100,000. Doesn't mean they can write off, their tax is going to be $100,000 less. So it's not a wash. If they donated $100,000, means the taxable income is going to be $100,000 less. So they pay, and based on the tax bracket, they pay that amount less on tax. So let's say if you want to go to heaven and say, oh, I already donated $100,000, so that you get the credit for $100,000, but you already just paid the actual paid amount, you paid $80,000. But I still get the credit for $100,000 donation, but the actual payout is $80,000. So you get kind of like a discount. It's not dollar by dollar off. But credit is like a gift card. This gift card is a dollar by dollar. Somebody give you a gift card, go buy that clothes, you go, and then sometimes you don't pay anything out of pocket because that gift card take care of it. But sometimes because deduction is a percentage wise, sometimes a deduction 20% of $1 million would be a better than a tax credit of $200. So at the end of the day, tax credit is dollar by dollar deduction from your tax bills. Tax deduction is the amount that bring down your taxable income that the tax is going to be calculated on. All right, we just covered some general questions about write-offs. There are a lot of detailed information about write-off. There are a lot of things that we can take advantage of, lower our taxable income and our tax bills. So feel free to reach out to us at the info@alamircpa.com and visit our website and let us know if you have any questions and send your DM or message. Thank you. Please like, subscribe our channel in YouTube and Instagram.